Brad Williams, Frugal Finance. Let's see what the black model does in terms of interest rate options. We're going to crunch some numbers, and here's a suggestion. Just plug and chug. If you have the underlying data, why brute force it? Just try to use the tools. In other words, the black model is proven. So the key thing here is just make sure your inputs match the formula and the logic. Clearly, black boxing it is not something you want to do. Try to figure out the logic. Why are you putting in a S or F or T, or in this case, we're looking at this continuous compounding or not. Let's take a look at how to do this. In this section, we apply the black model to a variety of interest rate options. As discussed earlier, in this section, a large market exists for options on interest rate futures. So we will consider an application of the black model to options on T-bond futures. The black model also applies directly to European options on a bond. Earlier in this section, we discussed forward rates in the market for FRAs. In this section, we also evaluate options on forward rate agreements, which are known as call and puts on SOFR. All of these applications are well suited to the black model. Options on T-bond futures. As discussed above, there's a robust market for options in interest rate futures. T-bond futures and options on T-bond futures trade on the CBOT. The T-bond future contract has 100,000 of bond principal as the underlying good, with the specification that the deliverable bonds are of maturity greater than or equal to 15 years. Prices are quoted as a percentage of the par value of the underlying bond. T-bond future options trade with expirations tied to each future's expiration and have prices expressed as a percentage of par. Future options generally expire in the latter part of the month before the corresponding futures expire. As an example, assume that today is February 20 and consider an option on the September T-bond futures. The option will expire in 6 months on August 20. As we're not interested presently in day count conventions, we treat the expiration as a half a year or 6/12. The current T-bond future price is 115 plus 11/32% of par equals 115.34375. The standard deviation of the future price is 0.15. The current short-term interest rate of 6.5%. We're going to assume that must be the risk-free rate. The yield curve is slightly upward sloping. So we assume that the 6-month zero coupon factor is Z. 0.6 equals 1.031746. We will price a call and a put, each with a strike price of 110. We have DISA 1 equals log normal F divided by X plus 0.5 standard deviation times 6 to 12 divided by 0.15 square root of 5. We've seen this before with a few variation. And then looks like squared, etc. is equal to DISA 2 equals DISA 1 minus the variance squared is equal to 0.5 minus 10 equals 0.394202. Find the cumulative normal values for the put and call. We have in DISA 1 F is equal to 0.691557, and DISA 2 is equal to 0.653294, and negative D would be equals 3048, and N equals 34716. Do you understand what we're doing here? We're having calls and puts and puts and calls. Assuming continuous discounting at the short-term rate of 0.605%, we have the following. This up here is 6.5. That was the answer. Continuous discounting. So we have C of F is equal to EXPR T of T F times and DISA 1 X and DISA 2. We have this EXP, and then you're just plugging and chugging here. Go back up here, and then you're going to start plugging in this information here, because 115,3435, this number right here, times N DISA 1 is 691557 minus 110, which is, it's got to be the call price. Was that the call or the current price? So you got 110 times 0.0653284 equals 7669 P TISA 1. So then you have 2.485. So it looks like this is the call price. This is your put price. If we wanted to take account of the shape of the term structure in pricing these options, we would use our zero coupon factor, 1.031746, instead of the EXP. So we have 1 divided by 1, etc., times the same 115, 69. Then we're going to follow the same structure, minus, we're just going to follow this formula. We have 766229064, and then the put is 2.4855. Because the term structure is upward sloping, the price reflecting the shape of the term structure are slightly lower than the prices based on the short-term rate. In our example, the term structure was only modestly upward sloping, so the price difference was quite small, less than 1 cent on each option. You can see right here. I need to take this number out. You can see here are the numbers, just FYI calculated. You can verify the accuracy of my typing as opposed to the actual numbers. You can see this number here, this 2.8, it's actually 2.48296 and 766229064, 2.48 against 76699, 2.5, maybe it's minimal. In a world of arbitrage, the law of one price, parity, you're going to see that if you can make in this world 1/64th of a cent on $1 billion, Wall Street will do that. Brad Williams, Frugal Finance. More to come.